In the last video I demonstrated a simple trading strategy. Now part of that strategy was that when we had entered a position we would close it when these moving averages crossed, and that would be our signal to close. Apart from having signals to close a position like a moving average cross, I am a big fan of having take profits, having a set price in the market that when hit gets us out of the market automatically in profit. And I'm also a big fan of stop losses, a set price in the market that when hit closes our position automatically in a loss. I do believe a take profit can be optional. I think you can close positions purely on signals in the market like a moving average cross, but in my personal opinion a stop loss is absolutely vital. This should not be optional as part of a trading strategy. Now let me give some advice on take profits and stop losses. First of all, our take profits, or our potential profit from a trade, should far outweigh the potential loss or the stop loss. So if we were to have a stop loss set at 20 pips, our take profit or potential profit needs to be much greater than 20 pips. It needs to be 40 pips plus to give us a risk reward ratio of at least 1 to 2. But I personally trade a lot higher risk reward, and I would be looking for a take profit of at least 100 pips for a 20 pip stop loss. The reason being, we want our potential reward or potential profit to far outweigh our potential loss. If we were to have a risk reward ratio of 1 to 5, we would only need to be right, or our speculations would only have to be right 20% of the time, and we would make a profit. If we could be right 40% of the time, a random number that comes to my head, and we had a risk reward of 1 to 5, we would be making strong profits from our trading, from only being right 40% of the time. And the reason being, when we do make a winning trade, it covers our potential loss and a lot more. Always ensure take profits far outweigh stop losses. Now, how do you determine your stop loss? I would suggest back testing your strategy to see what a reasonable stop loss would be. If you backtest the strategy by looking at price charts, and you find that when there are signals to open positions with your strategy and you have a 20 pip stop loss, it could be your speculation is correct, you have a signal to go long and you do, but you get stopped out, the stop is not wide enough. It could be that if you set your stop at 30 pips, then that's enough leeway for price to go against you before going on the upside, or vice versa. If we went short, it's enough leeway for price to go against you before it goes on the downside. So the best advice I can give for setting a stop loss is to look at historic price data and see what a realistic stop loss would be. Then how do we set our take profit? Well, we make it greater than our stop loss, and once again we can look at previous price data and see what a reasonable take profit would be from our trading strategy. So that's a brief video on stop losses and take profits. Thank you so much for watching, and please continue watching these videos.